Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into Healthy Choice Wellness Corporation's latest quarterly report. Get ready for a wild ride through balance sheets, income statements, and a few concerning financial cracks. It's a bit like finding out your healthy smoothie has a concerning amount of sugar. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more decoding fun. Let's start with the basics. Healthy Choice Wellness Corp, that's HCWC for short, is all about giving us healthier options. They own a bunch of natural and organic grocery stores like Ada's Natural Market, Paradise Health and Nutrition, Mother Earth, Storehouse, Greens Natural Foods, Elwood Thompson's, and Green Acres Market. They also have wellness centers that offer vitamin drips and shots and even sell stuff online at thevitaminstore.com. So a one-stop shop for your health kick, or at least that's the idea. Now, who supplies all this healthy goodness? They use a lot of different suppliers, from small shops to huge companies. For the first 3 months of this year, they bought 14% of their goods from UNFI and 26% from Kihi Distributors LLC. That means over a third of their products come from just two sources, which could be a problem if those suppliers have issues. Last year, UNFI was even more important, accounting for 37% of their purchases. Healthy Choice Wellness became its own publicly traded company back in September of 2024. Before that, it was part of Healthier Choices Management Corp, or HCMC. It's important to understand that they were only spun off in September, since this explains some of the previous figures that include comparisons to the previous year that have to factor in what it was like being part of the older company HCMC. Let's talk about something a little worrisome, the company's ability to continue as a going concern, which is business talk for whether they can stay afloat. As of March, they had about $1.8 million in cash, but they also had what's called negative working capital, meaning their short-term debts were far above what cash they had. They also lost about $700,000 in the first 3 months of the year. The auditors are worried about their ability to keep the lights on. Now let's get to the meat of it, the financials. Here are the highlights. Their cash and cash equivalents were nearly $1.8 million at the end of March. Sounds good, right? But compare that to almost $2.1 million at the end of last year. They burned through a significant portion of their cash reserves in just 3 months. Accounts receivable, a measure of how much money is owed to them, decreased slightly to roughly $471,000. This isn't a huge red flag, but it shows they're not collecting payments faster than before, which is not great. Inventories, the value of all goods they haven't sold, jumped up to about $7 million. That could be good if sales increase, but it also could be bad if they can't sell it in time before the vegetables rot. Here's where it gets interesting. Their total liabilities are almost $32 million, which is pretty high for a company with only $2 million in equity. Alright, with that context, let's check out the condensed consolidated statements of operations. Top scroll, bias days, and deleted net loss. Post per share scroll, debt increased to just selling more, but they're still losing money. Increased to just over $20 million, but their net loss was around $712,000. They're selling more, but they're still losing money, and this is reflected by a 7 cents loss per share. They're spending about 61 cents for every dollar of revenue, a number that's pretty average. Here's where things are less great. Operating expenses are at around $8 million. This eats almost all the gross profit. The issue here is that all the stores need to employ a lot of personnel and it is expensive to run. Now check out this part of the statement of cash flows. The cash flow provided by operating activities, which means how much they are profiting after expenses, is positive $1 million. At first it seems as if things are looking good. However, note that during that period their AR and AP changed by millions of dollars, meaning either if they could not collect their debt or that they delayed paying suppliers. This isn't a long-term solution, as these things always need to be paid and collected eventually. Let's check out debt. Their senior debt is at around $10 million. And since cash is just around $2 million, this leaves them with very little operating room and puts them at mercy to creditors. Finally, there's a legal proceeding pending where a former employee alleges a violation of state and federal wage laws. This stuff always costs money and might hurt their reputation. Okay, that was a lot. So what's the story here? It's mixed. On one hand, sales are growing, especially with the Green Acres acquisition, but they are losing money. They burn through a lot of cash and are increasingly dependent on suppliers. But most importantly, their losses might affect their ability to keep operating. So let's zoom out and see the bigger picture. For strength first, this report is still early for the spin-off. Most metrics can only be reasonably assessed a few reports down the line. It seems the overall direction is good considering that they managed to increase sales and maintain revenue with newly acquired stores. They have an opportunity to cut costs and renegotiate existing debts and contracts. Weakness-wise, Greenacre's market acquisition cost them $7 and it doesn't yet appear to be paying for itself. They need to make sure to integrate it more effectively or they risk losing out. Additionally, if their going concern status isn't resolved, then it might trigger a downward spiral. For the risks, their debt and the potential legal battle is worrisome, and a lot of things depend on it. In summary, things are not looking too hot for Healthy Choice Wellness Corp. Alright, that's our breakdown of Healthy Choice Wellness's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.